Hi, welcome to this video. We're going to continue the fundamentals of the stock market. For those that don't know me, my name is Austin. In this channel, we talk about personal finance, investment, and lifestyle. And if you guys enjoyed this video, please remember to like and subscribe to the channel. Today, we're finally going to get into the technical analysis, and we're going to go through some introductions and then the fundamentals of the candlestick charts. So let's first talk about what are the two main ways of predicting the stock market. One is the fundamentals analysis. Second is the technical analysis. Now, what is fundamental analysis? For fundamental analysis, is usually when the investor look into the company for their revenue, their expenses, their debt. They look into what's the organization structure and what's the confidence and the long-term outlook of the company. Essentially, it boils down to the longevity of the company. Do they think that this company is going to last long, etc. On the other hand, the technical analysis really only looks at two main components. One is the price of the share, and second is the volume, how much share is being traded at a given time. Now, when do you want to use and which method do you want to use, right? To answer this question, we first have to really understand at which time frame the investor or trader is really trading the shares at. We also need to understand stock market and stock trading. There's so much information, and you really have to boil it down to the most essential ones so that you don't get overwhelmed with information. So let's say if we're looking at buying and selling the shares within a few days to a week, this is really on a really short-term basis. In that case, I don't really need to care whether if the company has a long-term product plan, what is their quarterly result at the end of the month, etc., etc. All I really will care about is what is the price at the current time frame that I'm looking at, and how much of these stocks are being traded. Is there a lot of people selling and buying the stocks? Is this very liquid, etc.? However, if I am a passive investor, I'm investing in the long term, or I'm just an investor actively picking out my stocks, but I'm planning on putting it in there for long term, 6 months to many years, etc., then fundamental analysis is quite important. Because it is essential to choose a sustainable and growing organization. The prices fluctuation would be negligible in the long term. However, if the company does not do well, then the stocks will not grow. Hence, day traders or swing traders, which are short terms, they prefer technical analysis, whereas long-term investors prefers fundamental analysis. All right, that was a very brief introduction. Let's now talk about what are charts and what are candlesticks. When you look at a chart, it is basically the historical price of the product that is being traded at. For stock, the product is the specific company's stocks. So essentially, the chart shows the supply and demand and the prices at which of these products historically have been purchased at. There are many different charts. However, the two main popular ones are line charts and candlestick charts. In trading and investing, like I mentioned, there's so much information and there's actually so many different charts as well. But usually just want to focus on the core information. And in this case, let's avoid being overloaded. So let's focus on these two types of charts. Line charts are quite simple to understand. It essentially connects every price point at the chart's interval. So the chart's interval, I'm talking about the time interval. You could be looking at the price point on a daily basis, on a weekly basis. You can even narrow it down to 4-hour time frame, 1-minute time frame, etc. So if the time frame we're looking at is every day, then each price point is at the daily. So for example, today is Monday, and so there will be a price at Monday, Tuesday, Wednesday, etc., etc. And they will connect all these dots basically from the first day to the next day, all the way until today. So the line charts are actually really easy to understand, right? But it doesn't really bring enough information. Hence, most of the time, most traders look at candlestick charts. All right, let's talk about candlesticks. So candlesticks provide a lot more information for a single time point. If we're comparing this to a line chart will only show a single dot, versus a candlesticks actually shows a lot more information for a single time interval. So in this case, imagine we're still talking about on a daily time frame. We will be able to see the opening price, the close price, the high price, and the low price. So let's go into details about what each one of them really means. So let's use an example. Let's say we're looking at the price of Tesla stocks. And let's say the Tesla stocks is at $10 during the opening. So over here we can see that open price is $10. Then at the end of the day, when the stock market closes, the Tesla stock is now being traded at $12. So now this is the close price, right? However, during the entire day, the stock actually went all the way up to a high of $14. This is higher than the closing price, so it is still being shown over here as the high. We also have the low price. This just means that during the same day, the stock maybe also went down, but it went down to $9. So this is lower than the opening price. So again, we will see this in the candlestick itself. The candlestick, so in this case, the candlestick actually shows 4 different price points, right? And because the opening price is lower than the closing price, meaning that the stock actually went up during the day, then in this case, it is a bullish candle represented usually by a green candle. On the other hand, vice versa, you can imagine if the opening price is actually higher than the closing price, meaning that the stock actually dropped, then in that case, it is a red candle, right? The information is still exactly the same, except the open and the close is now reversed. All right, let's look at an actual example of the candlestick chart. We're looking at the S&P 500 index over here on a daily time frame. So each one of these candlesticks represent one day with the opening price and closing price. So if we see over here on May 2nd, what happened was the price started at 41.30, it closed at 41.55, and it went as high as 41.70, but it also dropped as low as 40.60, right? So these are the on a single time point, you can see the opening price, the high, the low, and the closing price, like we mentioned. The candlestick chart is great because it can also show the momentum of the price movement, right? What I mean by that is sometimes you can actually see these gaps where between the time frame, and these are the gap between the last close price and the current open price. This might happen if the market's view of the price has rapidly changed and all of a sudden there's an influx of buy or sell orders. In this case, it's sell orders, right? Maybe in this case, some news came out, right? Whatever it is, we can see that the candlestick chart really brings a lot more information versus if we are changing this to a line chart, all of a sudden you don't really understand what's going on, right? Sure, you can see the price is going down in this case, but you don't see any momentum. You don't see what is really some of the details that we can use candlestick charts to analyze further. So this ends the introduction of the candlestick charts. We'll go into a little bit more details in the following videos. I hope you enjoyed the video, and if you did, please again remember to like this video and subscribe to the channel. Thank you so much.